Whoa, careful there.
I almost did it again. I almost spilled my coffee all over the equipment.
You really need to get that checked out. Maybe a sippy cup.
Haha, relax. We're rolling, we're good. Let's do this.
Good morning, good afternoon, and good evening, wherever you are in the world, and welcome back to Sip&Talk.
Welcome, welcome, Sip&Talkers.
Phew. I'm Sunny, your friendly neighborhood tech watcher, and boy, oh boy, the listener portfolio we're looking at today, it's something else. This person is, let's just say, a true believer in tech.
A true believer is putting it mildly.
Okay, so get this. The portfolio is 50% in VOO, which is the S&P 500 ETF, then 15% in TSMC, 15% in a semiconductor index fund, SOX, and the last 20% in other stuff. This isn't just investing. This is like betting the entire farm on the future of chips.
It really is. And, you know, we've talked before about the outlook for the next few years, and this huge, this rigid demand for AI. The big question we have to tackle is, can that demand, as real as it is, actually hold up against the kind of risks we're seeing in the market right now?
Exactly.
So let me just jump in with a quick fact check, just a quick risk assessment right off the bat.
Go for it.
First, you've got massive concentration risk. I mean, this just flies in the face of any normal diversification principle. A downturn in just one single industry could be, well, catastrophic for this portfolio.
And that one industry is semiconductors.
Right. And second, there's a huge geopolitical blind spot. You might think, okay, I've got a Taiwanese stock and some U.S. stocks, so I'm spread out.
Geographically, yeah.
But you're not diversified from a geopolitical risk standpoint, because all those U.S. chip giants in the SOX index, they absolutely depend on TSMC's foundries in Taiwan for their most advanced stuff.
So if something happens there, everything goes down together.
Everything goes down together.
Okay, so look, we've done a ton of research, pulled a lot of data to help you analyze this, but we've got to say it. We are not financial advisors. We're data researchers.
This is just for analysis. It's for discussion.
Absolutely. So with that out of the way, today's big theme is we're looking at this through the lens of, like, The Big Short. Is VOO, the S&P 500, actually a bubble? And if it is, what's your next move? All right, let's dive right into this portfolio. 50% VOO, 15% TSMC, 15% SOX. Wow. The conviction here is just undeniable.
It is. And just to give everyone a sense of scale, the listener mentioned their TSMC holding. That 15% is worth about $500,000 in their local currency. So if you do the math, that puts the whole portfolio at, what, around $3.3 million? This is a serious amount of capital.
Very serious amount. And it's in a, let's call it a high-octane setup.
High-octane is the perfect word. I mean, let's start with the VOOP. That's the Vanguard S&P 500 ETF.
Yeah.
By its very design, it's weighted by market cap.
Meaning the biggest companies have the biggest share.
Exactly. So your exposure to the magnificent seven, NVIDIA, Apple, Microsoft, all the giants who are either making chips or buying billions of dollars worth of them, it's already huge. VO is kind of the default way to get a big slice of U.S. tech.
So you're already starting with a tech-heavy base?
A very tech-heavy base. And then this listener takes that base and adds another, 30%? Specifically piling into TSMC and other semiconductor companies. They're not just investing in chips. This is like super doubling down on the entire semiconductor cycle.
Which brings us to this idea of diversification, right? Because it looks like they're trying to diversify a little bit.
Right. On the surface, you see the logic. You're trying to spread your bets within the chip world. One part is TSMC. They're the manufacturing, the foundry, the ones physically making the most advanced nodes.
And the other part is SOX, which is the design and equipment side. The brains like NVIDIA and the tool makers like ASML.
So it looks like you've covered the whole supply chain.
Yeah.
From the guys who design the blueprints to the factory that builds the house.
But is that real diversification?
And that's the flaw.
Yeah.
I mean, this is a classic case of what we'd call a lack of sector diversification. It doesn't matter how you slice it up, whether you own the designer, the equipment maker, or the foundry. If global demand for semiconductors suddenly hits a wall, or if there's some big technological shift that makes a certain process obsolete, 60 to 70% of your portfolio is tied to that one single outcome.
So if the tide goes out for the chip industry, you're left holding a very, very big and very empty bucket.
The biggest bucket. And the basket you've put all those eggs in, it's sitting right on top of a massive geopolitical fault line.
This is the synchronization risk you mentioned earlier.
Exactly, the geopolitical synchronization risk. The money might be in U.S. and Taiwanese stocks, so the capital is dispersed. But the risk is not. It's all pointing to one spot on the map.
Well, let's walk through that. What's the nightmare scenario?
Okay, so imagine there's a major disruption in the Taiwan Strait.
Right.
If TSMC's operations slow down, or God forbid, stop, It's not just TSMC's stock that gets hammered.
Right.
It would immediately cripple every single major company in that SOX index. The NVIDIAs, the AMDs, the Qualcomms, all the companies that absolutely need TSMC's 3nm and 5nm nodes. You can't replace that capability overnight.
It's not like they can just call up Intel or Samsung and say, hey, can you start making our most advanced chips tomorrow?
Not a chance. The lead times, the integration. It's impossible in the short term. So what happens is their growth engine just stops. It seizes up, and their stock prices would fall right alongside TSMC's. They're synchronized.
So it really is like your analogy. You're betting on two different horses.
But they're tethered together in the same race. And if the track suddenly floods, both of them are going down at the same time. It's a huge single point of failure that's kind of hiding inside what looks like a diversified strategy.
But, okay, let's be fair. Let's play devil's advocate for a second. There's a reason for this level of conviction, right?
Oh, absolutely.
The person making this bet believes the AI wave is structural. This isn't just another tech boom and bust cycle. It's a fundamental shift for civilization.
And they see semiconductors as the, quote, indispensable food for everything that's coming. For AI, for 5G, for electric cars, for our entire digital future.
And from that point of view, companies like TSMC and NVIDIA basically have a monopoly on the processing power that makes it all possible. That justifies the risk, it justifies the high valuations.
The argument is, yes, I know the risk is high, but the protective moat around these companies is incredibly deep, and the demand is basically non-negotiable. The potential reward for being right about a shift this big is, well, it's astronomical.
It's a powerful story. It's like you're buying VOO, which is already the big tech buffet, right?
Yeah.
And then you tell the waiter, actually, I'd like 2 extra large servings of the prime rib, which are TSMC and SOX.
I like that. It's a great analogy. It's a high reward meal for sure.
Yeah.
But we have to warn you about the calorie explosion.
Risk explosion.
Exactly, the risk explosion that comes with that kind of extreme concentration.
Okay, so I think we've covered the portfolio itself. We see the bull case, the high potential driven by this AI supercycle. But we also see the massive concentration risk and the hidden geopolitical leverage.
Right, so now we have to zoom out. We need to look at the whole economic landscape, the restaurant, to use your analogy, and see if this high-risk pizza is being served up at a time when the whole system is maybe a little shaky.
So when we zoom out from this specific portfolio, the question becomes about the health of the entire U.S. market, which VOO tracks. Can the macro environment really support this level of bullishness?
That's the billion-dollar question. And to answer it, we need to look at a couple of key valuation metrics. We're using data from early December 2025 just to ground our conversation.
Okay, what are the vital signs?
First, let's look at the short-term indicator. That's the forward PE ratio. Basically, it's the price of the S&P 500 compared to what Wall Street expects it to earn over the next year.
And what's that telling us?
Our data shows it's somewhere between 23.2 and 24.1 times earnings.
So what color traffic light is that? Green, yellow, red?
That's a solid yellow light. Historically, our warning zone for that metric is somewhere between 22 and 25 times earnings. So we're at the very high end of that.
Meaning the market is priced for perfection.
Exactly. It means there's no room for error. The market is banking on companies hitting some pretty aggressive growth targets over the next 12 months. If there's any kind of disappointment, you could see a pretty sharp correction. It's a bit precarious.
But not, like, historically insane.
Not insane. But then we get to the second indicator. And this is where the alarm bells really start to go off.
Uh-oh.
This is the Shiller-Cape ratio, the cyclically adjusted price-to-earnings ratio. It's a much longer-term measure. It smooths out the ups and downs of the business cycle by looking at the price relative to the average inflation-adjusted earnings over the last 10 years.
So it gives you a much bigger, more stable picture of valuation.
A much more stable picture. And what is that indicator telling us right now?
I'm almost afraid to ask.
It is flashing a bright, flashing red light. The KP ratio is sitting between 38.9 and 40. We're just going to call it KP39.
K39. Okay, put that number in context for us. Why is that so scary?
It's terrifying because historically, the S&P 500 has only been this expensive twice. 2 other times in history. The first was in the run-up to the Great Depression in 1929.
Wow.
And the second was right before the dot-com bubble burst in 2000. Normally, the danger zone for this metric is somewhere around 30 to 35. At 39, we are in extremely rare, extremely overvalued territory.
So what does that mean for the future?
The clear takeaway from this data point, based on all historical precedent, is that long-term returns over the next decade are statistically likely to be very, very low, possibly even negative. The market isn't just a little pricey. It's priced at a level that signals a pretty profound level of financial hubris.
Okay, a number like KP39 that forces a really serious debate because the bull case, the one our listener is making, is basically built on the idea that this time is different.
And we all know what they say about those 4 words.
They're the 4 most dangerous words in finance. I know. But let's hear them out. What's the defense?
The defense is that AI isn't just another tech boom. It's a civilizational structural shift. It's not like the speculative internet companies of 2000. They argue that building out AI requires this massive, non-optional spending, a huge CapEx surge from all the hyperscalers, the Googles, Amazons, Microsofts of the world.
It's not a choice for them. They have to spend the money to stay in the game.
It's an existential arms race. The cost of not building out your AI infrastructure is seen as way higher than the cost of the chips themselves. So the argument goes, this mandatory multi-hundred-billion-dollar spending spree justifies these extreme valuations. They'd say the historical KP data is a fallacy in this new age.
It's a tempting argument, but haven't we heard this before?
We have. Think about it. In 1929, the structural shift was electrification, radio, the automobile. Huge, world-changing innovations. In 2000, it was the internet. Also world-changing.
The innovation was real in both cases.
The innovation was absolutely real, but the valuation model the market was using was broken. The excitement about the structural change made investors price these companies for a potential that was way beyond what they could actually deliver in profits.
So the problem isn't whether AI demand is real, it's whether that demand can justify a SAPI of 39 for the entire stock market.
That is the core issue. I'll admit, the AI wave gives a huge advantage to very specific companies with deep moats, like NVIDIA and TSMC. But that rigid demand can't protect the broader market from 4 critical risks.
The 4 horsemen of risks, lay them on us.
Okay, risk number 1, competition and custom silicon. The biggest customers for these chips, the hyperscalers, are all working like crazy to build their own.
Google has their TPU, Amazon has Trainium.
Exactly, and their goal is to control their own destiny and, more importantly, to crush the profit margins of their suppliers like NVIDIA. Rigid demand guarantees there's a huge market for chips, but it does not guarantee who gets the profits from that market.
Okay, that makes sense. What's number 2?
Risk 2, CapEx fatigue. That capital isn't infinite. Sooner or later, the CFOs at these tech giants have to stand up and prove that spending hundreds of billions of dollars on AI is actually making them money.
The return on investment has to show up eventually.
It has to. And if that killer AI app doesn't start generating huge profits as fast as they're buying the chips, the market will lose patience. And you'll see a really harsh correction in those valuation multiples.
It's the build it and they will come problem, but on a scale we've never seen before.
Precisely. Risk number 3, the rate effect. This is just boring old finance, but it matters. High valuations for tech stocks are justified by taking massive profits that you expect way out in the future and discounting them back to today.
Right.
But when interest rates are high, the discount rate is higher. It means those huge future profits are worth a lot less than today's money. So a high-rate environment is like a constant headwind pushing against these extreme tech valuations.
And the 4th risk.
Risk 4 is the big one. Rigid demand does not guarantee infinite profit. This is the simple counterargument to the whole bull thesis. Here's my analogy. Everyone needs water. The demand for water is about as rigid as it gets, right?
Can't get more rigid than that.
But if 100 different water companies start competing with each other, all their stocks are going to crash. The fact that AI demand is huge is not up for debate. But that fact alone does not justify buying the entire S&P 500 at a KP of 39. Price always matters.
So the bottom line is that AI demand is real, but it doesn't make the market magically immune to systemic risk.
Not at all. And the objective data, that KP39 number, is screaming that there's a lot of risk out there. It's telling you that no matter how bullish you are, you should probably be buying some insurance.
Which brings us to the structural flaw in the market itself.
Okay, let's get into this seemingly correct fallacy. This is a really fascinating and kind of scary idea. The paradox is that when millions of smart, rational people all do the same safe thing, buy a low-cost diversified index fund like VOO, their collective action actually creates a new massive risk for the entire system.
The pursuit of individual safety creates a collective danger.
That's the passive paradox in a nutshell. And this is where Michael Burry's analysis, the guy from The Big Short, becomes so important.
What was his take?
He drew a direct line, a direct comparison between the huge, unthinking flood of money into passive funds today and the synthetic CDOs that blew up the financial system back in 2008.
Wow, that is a heavy comparison. So before 2008, you had all this money flowing into these complex derivatives.
Right. Based on flawed risk models that said they were safe, the money was flowing in without anyone really looking at the junk mortgages that were underneath it all.
So what's the parallel to passive investing?
Burry's point is that the mechanism is the same. It's mechanical. Low-cost indexing has become the default choice for everyone's 401k, for every robo-advisor. Which means asset prices are no longer being set by people analyzing a company's fundamentals. They're being set by flows, by the sheer volume of money that has to buy the index, no matter what the price is.
So the price of a stock like Apple or Nvidia just reflects how much passive money is forced to buy it, not necessarily what the company is actually worth.
You got it. And this creates three huge structural problems. The first one is what we call the price discovery erosion.
Price discovery, explain that.
For a market to work efficiently, you need active investors. You need people doing the hard work, researching companies, reading financial statements, figuring out what something is actually worth. That's how capital gets allocated to good companies and avoids bad ones.
That's price discovery.
Right. But we've seen this tsunami of money moving from active managers who do that work to passive funds that don't. The data is stunning. In the U.S., passive funds now hold almost the exact same amount of assets as active funds. We're talking about over $4 trillion on each side.
So if everyone is just a price taker buying the index, who's left to actually set the price?
That is the critical vulnerability. And it's not just a theory. There are academic studies on this. They found that as passive ownership goes up, the amount of real information that gets baked into a stock's price goes down. One study found it was a 16% reduction in information getting into prices before earnings announcements.
16%. That's huge. It means the price is dumber. It's more likely to just follow momentum.
It's much more susceptible to bubbles. You have a shrinking number of active scouts trying to guide a massive, ever-growing herd of passive sheep. When the scouts get outnumbered, the potential for the herd to run off a cliff gets a lot bigger.
Okay, so that's flaw number one. Price discovery is breaking down. What's the second one?
The second flaw is the market cap trap. VOO's own rules make it a momentum accelerator. Because it's weighted by market cap, it is legally required to buy more of a stock after its price has already gone up.
So it's a self-reinforcing loop.
A massive one. A stock goes up, so it becomes a bigger piece of the index. So all the passive funds have to buy more of it, which pushes the price up even more. Success breeds risk.
And this creates what you call the illusion of diversification.
Exactly. You think you're safe because VOO holds 500 companies. And yes, it does protect you from one small company going bankrupt. That's idiosyncratic risk. But what it does is it creates this enormous, dangerous, systemic correlation risk.
Because the whole index is now anchored to just a handful of giant companies, the Magnificent Seven.
Right. So if those few companies all hit a wall at the same time, the entire index goes down with them in lockstep. You've diversified away the small risks, but you've massively concentrated the biggest one.
And that leads to the third flaw, which sounds like the real nightmare scenario.
This is it. The liquidity illusion and forced selling risk. In a bull market, you think you can sell whenever you want. Liquidity feels infinite.
The dangerous assumption is that there will always be a buyer.
But imagine a real crisis, a big geopolitical shock, another banking crisis, whatever, and everyone rushes to redeem their money from these index funds all at once. The funds are legally required to sell their stocks to give people their cash back.
So what do they sell?
And here's the disaster. To maintain the index composition, they have to sell their biggest holdings first. They have to sell the Apples, the Microsofts, the Nvidias. So you get trillions of dollars from hundreds of different funds, all being mechanically forced to sell the exact same handful of stocks at the exact same time.
And there's no way there are enough buyers to absorb that.
Not even close. The selling pressure would be absolute and violent. The price collapse wouldn't be driven by fundamentals. It would be driven purely by the mechanical rules of the passive fund structure.
The structure itself becomes an accelerator for the crash.
It's the ultimate crash accelerator. Burry's warning was that in 2008, the flaw was assuming housing prices could never go down. The flaw today is assuming that index funds are truly diversified and that liquidity will always be there. And the structure itself proves that's not true when things get ugly.
So if the whole system, the whole VOO structure, is anchored to just a few big leaders, then the failure of those leaders is where this abstract risk becomes very, very real.
Exactly. And we have to look at the two companies that are basically ground zero for this debate. The two stocks that short sellers are targeting the most, Nvidia and Tesla.
These are two of the biggest weights in the S&P 500, and the amount of money getting against them is just colossal.
It is. NVIDIA is the most shorted stock by dollar value. We're talking over $24 billion. And Tesla is right behind it with around 17 or 18 billion. The point is, if either one of these has a single stock collapse, the ripple effects through a market cap weighted index like VOO would be immense.
Okay, let's start with NVIDIA, NVDA. It's the king of the AI boom.
It's the king, but that also makes it the biggest target. And the biggest criticism from short sellers has centered on this controversial idea of circular financing.
Circular financing. This was a huge debate. What was the core accusation?
The allegation, brought up by people like Jim Chanos, was that NVIDIA might be, let's say, artificially boosting its revenue. The theory was that they were investing in their own customers, these smaller AI startups like CoreWeave, and then those startups would immediately turn around and use that same investment money to buy NVIDIA's chips.
So NVIDIA is essentially funding its own sales. It creates this internal feedback loop for revenue.
That was the accusation. And Chanos drew a really scary parallel to a company from the dot-com bust called Lucent.
What was the Lucent story?
Lucent was giving massive multi-year loans to its struggling telecom customers so they could afford to buy Lucent's equipment. When the dot-com bust happened and those customers went bankrupt, the loans went bad, and Lucent had to write off billions, destroyed them. The shorts were saying the principle is the same with NVIDIA.
That's a really serious claim. How did NVIDIA respond?
NVIDIA came out swinging. They put out a detailed memo to analysts, flatly denying the whole thing. They said their accounting is transparent, it's all by the book, and they pointed to a key difference from Lucent. Their customers typically pay them in about 53 days. These are real sales, not long-term, risky loans.
So they essentially said, our accounting is clean, move along.
Pretty much.
Yeah.
And for the most part, the market seems to have accepted that. But here's the crucial point. Even if the direct accounting fraud claim is off the table, the systemic risk is still there. We call it the migrated risk.
Migrated risk, what does that mean?
It means even if NVIDIA's books are perfectly clean, the risk just moves one step down the chain. Think about where all this money to buy these expensive chips is coming from. It's coming from unprecedented amounts of venture capital funding, private equity, and debt financing.
The whole AI ecosystem is running on this massive fire hose of speculative capital.
It's a capital consumption machine. And if that fire hose of funding suddenly turns off, maybe because high interest rates finally start to bite, or maybe a competitor's custom chip suddenly looks way better, then the demand for NVIDIA's chips could just evaporate overnight.
But the short seller's core concern is still valid, that this growth is built on a very unstable foundation of high-cost speculative money.
That's the migrated risk. The vulnerability is still there. It's just in the health of NVIDIA's customers, not necessarily in NVIDIA's own accounting.
Okay, so that's NVIDIA. Now let's talk about the other big one, Tesla, TSLA, the ultimate high-growth, high-controversy stock.
For short sellers, the bear case on Tesla is almost brutally simple. Its valuation today has almost nothing to do with its current business of selling cars.
It's automotive reality.
Right. As a car company, Tesla is facing falling profits, price wars, and huge competition. The stock price is not based on that. It's based entirely on the market believing it will win this multi-trillion-dollar bet on future tech, full self-driving, and the Optimus robot.
So it's a race against time.
That's a perfect way to put it. The core business, selling cars, is getting less and less profitable. Those declining margins are in a race against whether they can actually deliver on this huge speculative vision of robo-taxis. If FSD is delayed, or if it just doesn't work as well as promised, the whole story falls apart.
And there's huge outside pressure in that race, too, specifically from China.
This is the big one, the China factor. This is an external threat that could completely demolish their profit engine. You have Chinese EE makers who are rolling out cars with driver assistance systems that are, well, they're getting pretty close to what FSD can do.
And the crucial part is the price.
The price. They're putting this technology in cars that sell for around $30,000. That completely undercuts Tesla. If self-driving software becomes a cheap commodity, then Tesla's plan to charge $12,000 for FSD, which is the key to their entire future profit story, just vanishes.
And what's the systemic risk to VOO if that happens?
If that robotaxi dream dies, Tesla would have to be revalued as just a car company. And the result would be one of the biggest single-stock collapses in history. Because of how heavily weighted Tesla still is in the S&P 500, that one failure would cause cascading damage throughout the entire index. It proves that this concentration risk is very, very real.
Okay, so we've laid out all the risks. The super concentrated portfolio, the flashing red light of Cape 39, and these structural flaws in VOO that are anchored to these high-risk leaders like NVIDIA and Tesla.
Right. And we agree that the consensus view, the "this time is different" argument, is usually the most dangerous one in finance.
There's that great Mark Twain quote, "Whenever you find yourself on the side of the majority, it is time to reform or pause and reflect." And right now, passive index investing is the definition of being on the side of the majority.
So we're not saying get out of the market. We're saying you need a plan to manage the risk of being in the crowd. You need an anti-fragile defense.
So what's the playbook?
The philosophy here has to be dynamic risk management.
Yeah.
Every investor is caught in this trap, right? You have the fear of missing out on the bull market. The wolf didn't come.
And then you have the fear of the crash. The wolf came.
Exactly. Trying to time the market perfectly is a fool's errand. But just blindly holding on at a KP of 39 is also incredibly risky. So you need a middle way.
And that middle way is the core satellite strategy.
The 80-20 core satellite strategy. It's a disciplined approach. Let's break it down.
Okay.
The first part is your core VOO. We'll say that's 80% of your portfolio. This is your bedrock. You hold this no matter what. This keeps you in the game for long-term growth and stops you from making the fatal mistake of trying to time the market. And this is critical. You do not sell your existing VOO shares.
Why not?
Because that triggers taxes and it breaks the discipline of being a long-term investor.
Okay, so you hold the 80% core. What's the other 20%?
The other 20% is your satellite. This is your silver bullet. This part of your portfolio has to be in cash or other super safe defensive assets. Its only job is to protect you and to give you ammunition to buy when everyone else is panicking.
And given that we're at a CP of 39, you're saying that 20% target is where we should be now.
Yes. And here's the key part about how you get there. You're not selling your core. Instead, all of your new money, the money you save and invest each month, plus any dividends your VOO pays out, all of it gets redirected.
Where?
Straight into that silver bullet cash position. You keep doing that until you hit your 20% target. In effect, you're temporarily stopping your dollar cost averaging into VOO.
So you're stopping the leak first. You're not adding more risk at what might be the peak of the market.
Exactly. You're staying invested for the long run with your core, but you're building up an insurance policy against the wolf's howl.
Yeah.
You're trading a little bit of potential short-term upside for huge long-term stability and optionality.
That makes a lot of sense. But we all know the biggest enemy isn't the market, it's ourselves. How do you protect against your own brain?
That's the investor behavior gap, our tendency to buy high out of greed and sell low out of fear. You need to build behavioral guardrails to defeat your own worst instincts.
Guardrail number 1.
Avoid panic and rebalance systematically. When the crash comes, your gut will tell you to sell everything. But if you have that 20% silver bullet in cash, you have the power to do the opposite. When a 70-30 portfolio becomes a 50-50 portfolio after a crash, the mathematically correct move is to sell some of your safe stuff and buy more of the cheap stocks.
That's the hardest thing in the world to do emotionally.
It is. That's why you need an automatic trigger, a rule that says, when my allocation hits this point, I rebalance, period. It takes the emotion out of it.
In guardrail 2.
Use dollar cost averaging as an emotional bypass. Investing the same amount of money on a regular schedule, no matter what, is the single best weapon against emotional trading. It turns volatility from a threat into an opportunity because you automatically buy more shares when prices are low. It short-circuits the panic.
Okay, so you've got your strategy and your mental guardrails. What about specific assets? What actually protects you in a crash?
You need things that are truly non-correlated. Assets that zig when VOO zags. You're looking for what we call crisis alpha.
And what generates that?
First thing to look at is managed futures, or CTAs. These are systematic trend-following strategies. They use computers to trade futures contracts all over the world, stocks, bonds, currencies, commodities.
And how do they help in a crisis?
They are literally engineered to make money from volatility and clear trends. So when the S&P 500 is collapsing, the trend is clearly down. These strategies will automatically take short positions, which means they make money on the way down. They provide a return stream that has basically zero correlation to the panic in the stock market.
It's a quantitative, unemotional hedge.
Exactly. Second asset is an old one, gold and precious metals. Gold plays a dual role here.
Okay, what are the two roles?
In the short term, during the initial panic, gold is a classic safe haven asset. People flock to it when they're scared. But more importantly, gold is a hedge against what the government does after the crash.
Which is?
Print money. Economic historians have shown that after every major debt crisis, governments always resort to the same thing, debt default through debasement. They print huge amounts of currency to inflate away the value of their debt.
And gold protects your purchasing power against that inflation.
Because you can't print gold. It holds its value when the currency is being devalued. It protects you from both the crash and the cure.
And the third hedge.
The simplest but most important, cash and high-quality treasuries. You need absolute liquidity. This is the ammunition we talked about. Without cash, you can't be the buyer when everyone else is a forced seller. It's what gives you the power to actually execute your plan when the time comes.
Wow. We have really gone deep today into a portfolio, that is. It's really a perfect snapshot of the market's confidence, but also its fragility. The main takeaway for me has to be a call for discipline over passion.
I think that's exactly right. You can still be a huge bull on the future of AI. You can believe in that story. But you simply cannot afford to ignore the historical warning that a KP ratio of 39 is screaming at you. You have to believe in the long-term growth, but prepare for the short-term insanity.
And the best way to do that is the strategy you laid out, this dynamic risk management. When valuations are this extreme, taking your new money and building up that 20% silver bullet cash reserve, that's your insurance policy.
Don't try to time the market. Prepare your portfolio for the inevitable volatility. That's the only strategy that survives over the long run when you're facing this kind of seemingly correct fallacy.
So as we wrap up, we want to leave everyone with one final thought to chew on. We talked about the dual threat, right? The initial deflationary crash and then the inflationary government response that follows.
The currency debasement.
Right. So beyond gold, what other real assets are resilient against both of those threats? What tangible things that can't be printed by a central bank will hold their value through both market panic and long-term currency erosion? Something to think about as you build your own defenses.
That is a fantastic question to be researching right now, when the market is roaring. That's precisely when you should be thinking about the next storm.
Well, thank you all for joining us for this conversation on Sip and Talk.
We always appreciate you tuning in. Be sure to subscribe to Sip and Talk and also check out our good friend Mickey's YouTube channel. It's called Mickytolife. He's got fun memes, great travel vlogs. You'll love it.
We'll catch you next time.